Hello, this video we're going to cover Chapter 12. This will be the last chapter before we take our next exam. So this is the last material that you'll have to study for that. This one is on planning for capital investments. We're going to describe the capital budgeting inputs and apply the cash payback technique. We use the net present value method, identify capital budgeting challenges and refinements, use the internal rate of return method, and then use the annual rate of return method. These are all very good tools that kind of work together as you're looking at capital projects and trying to decide, what's the best option to use to go forward with. So for the purpose of capital budgeting, estimated cash inflows and outflows are the preferred inputs. Why? Ultimately, the value of all financial investments is determined by the value of cash flows received and paid. So how much are you going to pay, and then how much you're going to get back in return. So here's some typical cash flows relating to capital budgeting. You're going to have your initial investment. So you're going to pay whatever you need to pay for the piece of equipment, the building, whatever your project you're working on. You'll have repairs and maintenance throughout the life. You could have increased operating costs. You're going to have overhaul of equipment that you'll need to do throughout its life. The cash inflows, you may sell an old piece of equipment to make room for the new piece, so you could have some proceeds from that sale. Sometimes you do this to increase the cash received from customers, so additional sales or new sales of a new product. We have reduced cash outflows related to operating costs. So you may be more efficient and be able to reduce some operating costs with new equipment. Now we have the operating costs both inflow and outflows. So you just have to be cognizant of that and know that, yeah, you can have increased operating costs, but you also could have reduced operating costs as well. And then salvage value of the equipment. So the new equipment you're buying is going to have a salvage value at the end of its life that you use in the process as well. Considerations, the availability of funds. If you don't have the cash on hand, you're going to have to go borrow it. Relationships among proposed projects. So we'll see, what do you do if you have multiple projects proposed at the same time and trying to decide between them. The company's basic decision-making approach, which is just, simply how do they make decisions, what measures do they use that they find most important, and we'll see a bunch of different ones that we can use for capital projects. And then the risk associated with the particular project. So you may have to put some risk assessment on different projects. So here's some data for an example. Stewart Shipping Company is considering an investment of $130,000 in new equipment. So we have our initial investment. We think it's going to be 10 years useful life, 0 salvage value. Estimated annual cash flows are cash inflows from customers $200,000, cash outflows for operating costs $176,000. So net annual cash flow is $24,000. Cash payback equation, using the cash payback technique, identifies the time period required to recover cost of capital investment from the net annual cash inflow produced by the investment. So again, a lot of words, but basically what it's saying is, if I have to spend money on a capital project and I'm going to get positive cash inflows from that project, how soon before I recover my initial investment? Okay, so in the Stewart's example, or the formula, we'll start with there. The cost of capital investment divided by the net annual cash flow gives you our cash payback period. So in the case of Stewart, it's $130,000 initial investment. We get $24,000 net cash inflow. So 5.42 years before we recoup that $130,000. Now this cash flow is cash. So we're going to see in another example where that gives us net income, and we have to calculate cash flow from that. So depreciation is going to be the big one that we deal with in this chapter of adding that back to net income to get the cash income, which is our cash inflow. So just be aware of that as you're seeing different problems. A shorter payback period equals more attractive investment. Makes sense. The sooner you can make your money back, you'll have that money back and can do other things with it. In case of uneven annual cash flows, company determines cash payback period when cumulative net cash flows from the investments equals the cost of investment. Okay, so if it's the same cash flow every year, so it's an even annual cash flow, then we do the formula we just did where the investment divided by those cash flows. If it's uneven, so we have 60,000 one year, 90 the next, 100 the next, something like that, we have to look at the cumulative net cash flows. So in this case, Chen proposes an investment in new equipment that is estimated to cost $300,000. So we say the investment is year zero, 300,000 is our cash outlay. Our net cash inflows from that, year one is 60,000, year two is 90,000, year three is 90,000, year four 120, and so on. So we just then have to keep track of our cumulative. So after 1 year, it's the 60. After two, it's the 60 plus the 90, so 150. So we're halfway there after 2 years. Another 90 in year three gets us to 240, almost there. The full cash flow in year four is 120,000, which gets us to 360 cumulative, which is more than the investment. So if we kind of look in between there, 60,000 is half of the year four cash flow, so we'll call it a half a year to get us to 300,000. So 3.5 years would be the cash payback period. So it's the same idea that we did with the investment divided by the annual cash flows. It's just we have to add up that cumulative and find where it equals the initial investment. So a review question. A $100,000 investment with no scrap value has an 8-year life. Compute the payback period if straight line depreciation is used and net income is determined to be $20,000. So the net income is annual net income. So we're going to get that $20,000 each year in net income. Formula again is the payback period equals the investment divided by the cash flow. So now I have to determine what our cash flow is. I mentioned this earlier that net income is as we learned from Accounting 101, it's an accrual basis, unless it says it's cash net income. So we assume it's accrual basis, which includes depreciation. And we knew from our 101 class that we add back depreciation to get to net cash income or cash flow. So that is one adjustment we're going to do. We have no other data, so we're not going to worry about any other add backs. So we'll take our cash flow equals our net income plus depreciation expense. Depreciation expense, we see from the problem, it's an 8-year life, no salvage value, no scrap value. Okay, so it's simply the $100,000 divided by 8, so $12,500 a year. So our cash flow is $20,000 net income plus the $12,500 depreciation, which is a non-cash item. So $32,500 is our annual cash flow. Then we can use the payback period formula, and we get 100,000 divided by 32,500 is 3.08 years. So we had to do a little bit more to calculate the depreciation expense, but using straight line in a lot of these examples and in your homework, it's easier to figure out. So let's do another example. Watertown Paper Corporation is considering adding another machine for the manufacture of corrugated cardboard. The machine would cost $900,000. It would have an estimated life of 6 years and no salvage value. The company estimates that annual cash inflows would increase by $400,000 and annual cash outflows would increase by $190,000. Compute the payback period. So the first thing we have to do is figure out what our annual cash flow is. We have inflows of 400, outflows of 190. So we net those together and we see that we get 210,000 cash inflow on an annual basis. Okay. Next, we'll calculate the cash payback period. Again, it's the investment divided by the cash flow. So the 900,000 divided by 210,000 is 4.3 years. So that's just using simple cash flows to see when we recoup our money. Now we'll look at the net present value method. This is the discounted cash flow technique. Generally recognizes the best approach, considers both estimated total cash inflows and time value of money. Two methods that we'll look at, the net present value or NPV and the internal rate of return or IRR. So when we use the net present value method, we're going to discount the cash inflows to their present value and then compare that with the capital outlay. Okay, so when we talk about money, $1 today is worth more than $1 in the future for different reasons. Finance class will really get into that, but we use it in accounting as well. So we're going to take that future cash flow and bring it back to today's dollars. So we'll get a different number than what the sum of the cash flows would be, and then we can compare that against what we're going to spend today on the investment and see if it's a good investment that way or not. So the interest rate that is used is required minimum rate of return. So companies will set what they want their minimum rate of return to be. Proposal is acceptable when net present value is 0 or positive. The higher the positive NPV, the more attractive the investment. So here's kind of how we look at that in a graphical thing. We have the present value of the net cash flows less the capital investment equals the net present value. If it's 0 or positive, we accept the proposal. If it's negative, we reject the proposal. And then it's also a good way to compare multiple proposals at the same time. In the Stewart Shipping Company example, company's net annual cash flows are $24,000. If we assume this amount is uniform over the asset's useful life, we can compute the present value of the net annual cash flows. Okay. So there's tables available that have present value of $1, present value of an annuity, future value tables for the same thing. So if we're just looking at a cash flow in the future, a one-time cash flow, we'll take the present value of $1. If we look at an annual cash flow like this example where we get the same amount every year, we can do an annuity. So if we look up the tables, and I know in the homework they link you to some tables so you can look up the factors as well. You look at the interest rate across the top of the table. We'll go to 12% in this case. Down the rows are the number of periods. So in this case, 10 years, 10 periods, we go down 10. So if we go over to 12%, down to 10 periods, we find that is 5.65022. So we multiply that 24,000 times 5.65022, and we get 135,605. So that's the present value of those cash flows. And we see that that is a smaller number than if we just took the 24,000 a year times 10 years, $240,000, because we're bringing it back to today's dollars. Um, so it's got a different value than that, what it is in the future. Then we get the net present value by taking the present value of the cash flows, the 135,605, less our capital investment of 130,000. We have 5,605. That's a positive number. So the proposed capital expenditure is acceptable at required rate of return of 12% because that net present value is positive. So what happens if we have unequal annual cash flows? So with Stewart shipping example, we expect the same total net cash flows of $240,000. Again, that's at 24,000 annually times 10 is how they got that. So we are expecting that same total, but the declining market demand for the new product, the net annual cash flows are higher in the early years, lower in the later years. The present value of the net annual cash flows then is calculated as follows. So we're going to take the discount factor, or the present value factor. Now we're just going to look at present value of $1. So we'll use that chart instead of a present value of an annuity. And we have to take each year separately and the new discount factor each year, calculate each of those, and then sum them up. So we're still using that 12% column, but first year we'll go to 1, next year we'll go to year 2, next is period 3, and so on, and that's where we get the factors from. So you see the further out you go, the lower the number, so the lower present value is. So now we'll use that 144,367, compare that to the capital investment of 130. Still positive. In fact, it's higher than it was before because we're getting more cash flow earlier. So again, the proposed capital expenditure acceptable at a required rate of return of 12% because the net present value is positive. How do companies choose a discount rate? It's the rate to obtain funds from creditors and stockholders. In most instances, a company uses a required rate of return equal to its cost of capital. That is the rate it must pay to obtain funds from creditors and stockholders. So if we're going to go out and borrow money for this project, what's our interest rate we're going to pay, cost of capital. We also look at some risk. So we may increase that more than what our actual loan might stay at the interest rate is. And then that rate that we use could also be known as the required rate of return, the hurdle rate, cutoff rate. All are mean really the same thing. It's that rate that you're going to use to discount your cash flows to make that comparison. So Stewart Shipping used a discount rate of 12%. Suppose this rate does not take into account the risk of the project. So if we add risk to that, a more appropriate rate might be 15%. Okay, so all that doing is adding in what happens if our projections are a little aggressive, we don't make the sales that we think we're going to do, costs us more to operate, things like that, because those are all estimates when you're looking at the project. So you put some of that risk in. In this case, they took it to 15%. When they do that, assuming the 24,000 a year cash flows, we have a different discount rate to get it to present value because it's 15% instead of 12%, still 10 years. And we see that our net present value is negative. So our cash inflows over the years at 15% are less than our cash outflows. So then we would not be that acceptable of this project because we have a negative net present value. Some simplifying assumptions. All cash flows come at the end of the year. So when we look at the present value, it's the present value of $1, and at the end of the year, so we can count the years a little easier, and then it's the present value of an annuity instead of an annuity due. So it just kind of takes some additional thought and calculations out of it. Makes it a little simpler. All cash flows are immediately reinvested in another project that has a similar return. So we don't have to do any additional calculations, but making that assumption that, yeah, we go ahead and reinvest that money and it's not just sitting there. And then all cash flows can be predicted with certainty. Again, they're estimates, so you don't know how certain that is, but we make the assumption that it's a pretty solid um, estimate, and go with that. Let's do another review question. Compute the net present value of a $260,000 investment with a 10-year life, annual cash inflows of $50,000, and a discount rate of 12%. Okay, so we're using cash inflows, so it's not net income, so we don't have to do the adjustment for depreciation. If it says cash inflows, then we know it's already cash basis. Again, if it says net income, we assume depreciation is in it, so no adjustment there. So we're going to take the present value factor times the annual cash flows minus the investment. So it's the present value of an annuity. We're going to use 12%, number of periods is 10. So this is just how I like to keep track of what I'm going to look up in that present value of an annuity table. If we look up the table, it's 5.65022. It's also the same one we used in the earlier example, so we could go back to that example as well. $50,000 annual cash inflows. So we have that, and we're going to subtract then $260,000, and our answer is 22,500 positive. So we would accept this project because we have a pretty good, a strong positive net present value. So let's walk through another example. Best Taste Foods is considering investing in new equipment to produce fat-free snack foods. So we have all this information. The initial investment's $1 million. In 5 years, we're going to have an equipment overhaul. It's going to cost us $200,000. Our salvage value of the equipment in 10 years is 20%. Our cost of capital, our discount rate is 15%. We're going to have cash inflows from sales, cash outflows for cost of goods sold. We'll have maintenance costs and other operating costs. So those are all cash flows. And if we compute the net annual cash flows from this project, we have our inflows from sales, outflows for cost of goods sold, maintenance, and other operating costs. So we get $230,000 annually in cash inflows. If we take the next step and compute the net present value, here's what that will look like. So net annual cash flows for 10 years, it's $230,000. Our discount factor of 15% is that 5.01877. So we get $1,154,317. Salvage value is $20,000 in 10 years. We discount that back to today's dollars. So we'll look up 15%, 10 years for our present value of a dollar, not the present value of an annuity. That first factor is an annuity. We're going to subtract our equipment purchase of $1 million. It's a 1 for the discount factor because it's already at today's dollars. Then equipment overhaul that we're going to do in 5 years, $200,000. We again look up that 15% for 5 years and get that factor to bring that cash outflow back to today's dollars. If we net all this together, we get a positive net present value of $59,825, which will make this project or this proposal acceptable. let's look at a different problem and go through this. So Watertown Paper Corporation is considering adding another machine for the manufacture of corrugated cardboard. Machine will cost $900,000. Estimated life of 6 years, no salvage value. Company estimates that annual cash inflows would increase by $400,000, annual cash outflows would increase by $190,000, and management has a required rate of return of 9%. So we're going to calculate the net present value of this project and determine if it is acceptable or not. So we'll start by getting our annual cash flows. So 400,000 inflow, 190,000 outflow. The net is $210,000 inflow. We will get the present value of those cash flows. We'll use 9% in 6 years, look up that factor, multiply it by the $210,000, and then subtract our capital investment of $900,000 from that, and we see that the net present value is positive $42,043. So the NPV is greater than zero. Watertown should accept the project. So let's look at some capital budgeting challenges and refinements. Intangible benefits. So might include increased quality, improved safety, or enhanced employee loyalty. So to avoid rejecting projects with intangible benefits, calculate the net present value ignoring the intangible benefits, and then project conservative estimates of the value of intangible benefits and incorporate these values into the NPV calculation. So this is, again, another estimate that management comes up with of what the value of these intangibles are. So we have our initial investment, annual cash inflows, annual cash outflows. The net annual cash flow is $30,000, 10 years, 12% discount rate. We calculate the net present value like we just saw in the last section. We see it's a negative $30,493. So that is something we probably wouldn't accept at that 12% discount rate. But Berg estimates that improved sales will increase cash inflows by $10,000 annually as a result of the increase in perceived quality. Berg also estimates that annual cash outflows would be reduced by $5,000 as a result of lower warranty claims, reduced injury claims, and fewer missed workdays. Using these conservative estimates of the value of the additional benefits, should Berg accept the project? So we're going to redo our net present value. We're going to add the $15,000 additional cash inflow. So 10,000 inflow, 5,000 reduced outflow. So we netted that we're at $45,000. And now if we use that cash flow, we see that we have a positive net present value. So with those intangibles, we're able to quantify them, and this would be acceptable. Proposals are often mutually exclusive. Managers choose between various positive net present value projects because of limited resources. It's tempting to choose the project with the higher net present value. It kind of makes sense. If you have a higher net present value, it's worth more. Let's look at these two projects, two mutually exclusive projects, each assumed to have a 10-year life and 12% discount rate. We have our initial investments for both, annual cash inflows from both, salvage values, present value of the cash flows. It did the calculations for us. And when we take those present value of cash flows minus the initial investments for each project, they are both positive. Project A is $18,112. Project B, $20,574. But now we can look at the profitability index. So it's one method we can use to compare different projects. So the present value of the cash flows divided by the initial investment will give us that profitability index. So project A is 1.45, project B 1.23. So project A has a lower initial investment. The net present value of the cash flows isn't that different. The present value is higher for project B, but when we did just the net, we were only off a couple $1,000. So project A is going to have the higher profitability index. So if we use that as a tool to help us decide, we would lean more towards project A in this case. So let's go through a review question. Assume project A is a net present value, net cash inflows of $79,600, initial investment of $60,000. Project B has a present value of net cash inflows of $82,000 and an initial investment of $75,000. Assuming the projects are mutually exclusive, which project should management select? So again, we take the present value of the cash flows minus the initial investment gives us our net present value. So using that, we would select project A as a $19,600 net present value. Project B has a $7,500 net present value. So a simplifying assumption made by many financial analysts is that projected results are known with certainty. Okay. Projected results are only estimates. A sensitivity analysis is used to deal with uncertainty. Use the number of outcome estimates to get a sense of variability among potential returns. So we could either change the interest rates, we could change our cash flow assumptions. What if we were off 5% or something on our cash flows and it was lower? What would that look like? So there's different ways we can do that sensitivity analysis and then kind of come up with a range of where we think the project is versus just one number. And then performing a post-audit is important. So managers, if they know their estimates will be compared to actual results, they'll be more likely to submit reasonable and accurate data when making investment proposals. Provides a formal mechanism to determine whether existing projects should be supported or terminated, and it improves future investment proposals. So this is a very important step. A lot of companies don't do it very well, if they do it at all. But it's really good to go back and say, okay, we said this 2 years ago. Here's what really happened since then. Did we make the right decision or not? What changed from our estimates to the actuals, and how can we use that to influence our next proposal that we do, and how we think about our estimates. So let's go through this one. TAS Corporation has decided to invest in renewable energy sources to meet part of its energy needs for production. It is considering solar power versus wind power. After considering cost savings as well as incremental revenues from selling excess electricity to the power grid, it has determined the following. So we have our present value of annual cash flows from both options and the capital investments from both options. Determine the net present value and profitability index of each project. Which energy source should it choose? Okay, so we're going to take net present value, which simply present value of the annual cash flows minus the capital investments. And then we're going to calculate the profitability index, which is the present value of annual cash flows divided by the capital investment. So for solar, net present value index is 33,080 and a 1.73 profitability index. Wind, higher net present value, 43,150, so just over 10,000 higher, but a lower profitability index at 1.34. While the investment in wind power generates higher net present value, it also requires substantially higher initial investment. So that's why the profitability index is lower. That profitability index favors solar power, which suggests that the additional net present value of wind is outweighed by the cost of the initial investment. The company should choose solar power. Now let's look at the internal rate of return method. It differs from the net present value method in that it finds interest yield of potential investment. Internal rate of return is the interest rate that will cause present value of proposed capital expenditure to equal present value of expected net annual cash flows. So that means that our net present value is going to equal zero. How does one determine the net internal rate of return? So we'll go back to our Stewart shipping. It's considering the purchase of a new front-end loader at a cost of $244,371. Net annual cash flows from this loader is estimated to be $100,000 a year for 3 years. To determine the internal rate of return on this front-end loader, the company finds the discount rate that results in a net present value of zero. So we're going to just look at our different discount rates. So we start at 10%, calculate the net present value of that. We'll do it at 12%, calculate that, and then 11%, and that's where we see that it's zero. So the internal rate of return is 11%. Now, if you have to do this continually and you'll pick a rate, see what that is, then determine where to move next. It may take you a while to hone in on exactly where it is. Easier way to do it when net annual cash flows are equal is take our capital investment divided by our net annual cash flow, and that gives us a factor. If we go to the present value of an annuity table, we know the number of periods, so 3 in this case, and we go across that 3 until we find that factor that we calculated, and then go up, we find the 11%. So we use our tables kind of backwards from what we were doing before. And of course, there's a lot of softwares that can do this as well, financial calculators, Excel, that type of thing. You can just plug in the cash flows and the investment, and it will calculate the IRR for you. So how do we use it? We compare our internal rate of return with the company's required rate of return, the discount rate. If it's equal to or greater than, accept the proposal. If it's less than, we reject the proposal. So let's look at these two discounted cash flow methods. The net present value, the objective is to compute net present value, a dollar amount. The internal rate of return is to compute the internal rate of return, which is a percentage. The decision rules we have for net present value: if net present value is 0 or positive, accept. If it's negative, reject. For internal rate of return, the internal rate of return is equal to or greater than the required rate of return, accept the proposal. The internal rate of return is less than the required rate of return, reject the proposal. So let's go back to our Watertown paper example. Remember, we're going to purchase a new machine, $900,000, 6-year estimated life with no salvage value, annual cash inflows would increase by 400,000, annual cash outflows would increase by 190,000, which gives us $215,000 net cash inflow. Required rate of return is 9%. Calculate the internal rate of return on this project and discuss whether it should be accepted. So remember, we're going to take the cost divided by the net annual cash flows to get our present value factor, and then look that up in the chart. So our 210,000 net annual cash flow, we take the 900,000 divided by that 210,000, we get 4.28571. Now if we look in the table, here's an example of the table. We know it's 6 years, so if we go across that 6-year column, the 4.2857 doesn't exactly match one of these, but it's in between 10% and 11%. So since the project has an internal rate that is greater than 10%, the required rate of return is only 9, we should accept the proposal. Now we'll look at the annual rate of return method. Indicates the profitability of capital expenditure by dividing expected annual net income by average investment. So expected annual net income divided by average investment gives us our annual rate of return. So Reno Company is considering an investment of $130,000 in new equipment. The equipment is expected to last 5 years and have 0 salvage value at the end of its useful life. Reno uses straight line depreciation. So we'll have our sales of 200,000, manufacturing cost without depreciation, our depreciation expense for this equipment, selling and administrative expenses, gives our income before taxes, then we subtract our income tax expense and we get net income. So to get annual investment, we take our original investment plus the value at the end of useful life divided by 2. So if we go back here, $130,000 is the new equipment, 0 salvage value. So 130 plus 0 is 130 divided by 2. Our average investment is 65,000. So we take our net income, annual expected net income divided by an average investment is the formula. So we take our net income of 13,000 divided by 65,000. 20% is our annual rate of return. Project is acceptable if its rate of return is greater than management's required rate of return. So again, in this case, we're taking net income, which includes depreciation expense. We're not taking cash flows. So back to Watertown, same machine, 900,000, 6 years, no salvage value. Annual revenues increase 400,000, annual expenses increase 160,000. 210,000 is our cash flow, but we need net income to calculate the annual rate of return. So we got to figure out our depreciation on this machine. Using straight line, no salvage value, it's simply 900,000 divided by 6, so $150,000. So our net income is $60,000. Annual investment, average investment, 900,000 plus the salvage value, which is 0, divided by 2 is 450,000. Annual rate of return is the $60,000 net income divided by that 450,000, and we get 13.3%. Since the annual rate of return is greater than the required rate of return of 9%, the proposed project is acceptable. So you can see as we went through there, that same project for Watertown, we looked at it um, multiple ways, used all the um, ways that you can analyze a capital project. I think every time we said it was acceptable, so looks like a pretty good project there. So that's it for Chapter 12. As usual, reach out if you have any questions or have any problems. Thank you.